Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Well, welcome back to another episode of the ASB Investment Podcast. I'm your host, Nigel Grant, and today we're focused mostly on ASB's portfolios, how they went last year, how they're positioned at the start of 2025. It's kind of like a school report card. And after that, we'll chat through how the year has started off, what's going on in markets, and what that means for ASB portfolios and for customers. And to take us through this, we have the pleasure of having two very familiar guests back in the studio with us. The first is the captain of the HMS Portfolio Management, the keen yachty, or is it boat yachty, one of the two, coming to us live from Sydney. He's not with us today, but he's coming to us live from Sydney. It's the head of multi-asset solutions for BlackRock. It's David Griffith. How are you and what have you been up to, David?
Well, good morning, Nigel. I'm very good, thank you. I love that title, Captain. That's great. I love how you weave a sailing or a boating analogy into these podcasts. What have I been up to? I guess fresh off the weekend, my son went to a chess tournament yesterday. So that was quite interesting. First time I've been there. So he didn't win, unfortunately. There was a lot of clever chess players out. There was actually a grandmaster of chess in attendance. But it was quite interesting to see.
Well, we look forward to having him on the podcast in a couple of decades' time when he's a grandmaster. And finally, to the man who's with me in the studio, he just loves my big-winded introductions, random name associations. They can generally go anywhere, just like the latest tariff overnight announcement. It's a welcome back to John Smith, the head of asset management at ASB. How are you and what have you been up to, John?
Yeah, look, I'm well, thank you, Nigel. And I've just been enjoying the summer we've been having. It's actually been really, really warm. It's just nice. But the farm's suffering a bit. There's just no grass.
Oh.
We spend a lot of time watering and a lot of time feeding out hay. So, yeah. But, there's always upsides and downsides from everything, right? It's a lovely summer for most people, but not so easy on the farm.
And so the first thing we get into today is, I guess before we get into kind of the nitty-gritty of what's been going on, just a quick reminder to our listeners, to you, John, what is the partnership with BlackRock and the benefits, or why we choose to work with BlackRock in the way we do?
Yeah, so look, if I just step back and just talk about the way that ASB actually structures and manages money, we're responsible for managing and achieving greater investment outcomes for the products that we offer to our customers. That's ASB KiwiSaver, ASB Investment Funds, and ASB Portfolio Series. The way we go about doing that is we use the best investment managers we can get from around the globe, and we employ people in a couple of different ways. Underlying investment managers, they manage the stocks and bonds that are actually invested in markets, and we pull those in things we call asset classes. Mm-hmm. And then we also have a role called portfolio manager, and the portfolio manager, that's BlackRock, and that's where David Griffith is doing his job here, is responsible for allocating the money between those various underlying managers in a way which is to we expect David and the team to outperform the underlying long-term reference benchmark in doing that. So I suppose the way I consider our approach is that we're the manager and the coach. We put a team on the field. We select that team. That's the underlying managers and the portfolio manager. The portfolio manager is the captain, and they run the team on the pitch. So essentially that's the role that we have with BlackRock, and BlackRock's role here is really to architect the whole portfolio positioning so that we get the best outcomes for our customers.
I like how you use the captain reference.
I already used
like that? I liked it. I liked it. You went there.
I saw you use that earlier, you see.
Gosh, you are so nimble. David, to the captain himself, in terms of your view on the partnership, HMS or captain of the HMS, whatever analogy we want to use?
Yeah, thanks, Nigel. Yeah, look, very much agree with John there. Look, from my perspective, in terms of the partnership with ASB, it's really around delivering exceptional investment performance. That's what we aim to do. And my role in that is really to bring the best of BlackRock's thinking to the ASB portfolios. So obviously, we've got a large team of portfolio managers all over the world, a lot of great investment insight. We've got a BlackRock Investment Institute, our local multi-asset team here on the ground to distill all of them information and, really try to strive to achieve the best performance outcomes for ASB and ASB's customers. And then beyond that, it's really beyond just, the investment performance outcomes. There's other things that BlackRock helps with as part of this partnership. It's things like product design, as an example, help with marketing, long-term strategy. All of these aspects, form part of the partnership with ASB.
And John, to you, I guess, next, given this is our first podcast, our first podcast, us three, for the year after our year-end one, we're wondering if you can, I guess we're going to start with a bit of a recap of where we were in 2024, where we finished up. Some of the stuff has flown through into the year we're in now. David, we're going to talk to you in a second about in terms of, performance of the portfolios and what worked and what hasn't. But John, first to you, with everything going on, we're sometimes guilty of not stepping back and reflecting on the significant milestones we've achieved. What are some of those key things that ASB has done in the last year?
The interesting thing is that when you're doing investment management, you sort of you do things in a year, but it's what happens over the longer periods that is really, really important. And this year, to me, has been a year where I think that the benefits or the fruits of the decisions that we've made to a point, particularly BlackRock in 221, have been really starting to become noticed. The performance has been improving for each year since then, but this year we've got a really good 1 year performance and 3 year performance. That's been recognised now by us being selected as KiwiSaver Fund Manager of the Year nominee, and I think that's a really, really good testament to the value of the decision we made and the results that BlackRock has been giving for our customers. I mean, we're top quartile relative to most of the peers in the marketplace on a 1 or 3 year basis. And BlackRock have outperformed the benchmark by sort of 1%, which is quite a lot. It makes a difference if you're continuously adding that sort of value over the long run. Really makes a difference to our customers. So that for me, I think, is what this year's been all about. Is just like it is in an investment sense, you get years when the value of decisions you made years ago actually sort of come out, and it just reinforces for me the investing's a long game. Decisions are things that play out over years.
I feel like there's oodles of farm analogies in terms of you planting cherry trees that others could sit under.
Yeah, things like that. Yeah, absolutely.
Yeah, I'll weave some of those more into next episode. And David, in terms of, I guess, more specifically the performance itself, John's touched on kind of the outcomes of that. What John didn't mention that I think is really critical is all of that has flown into great outcomes for customers
totally.
As well. But in terms of, Griffith, what was achieved in 2024, what worked and didn't work in the portfolios, do you think?
2024 was a really great year for the portfolios. John mentioned, I think, the 1% outperformance over the 3 years. For 2024, it was something like, for balance, it's about 2.4%. So, quite strong outperformance relative to the reference benchmark. For me, what was pleasing was that it wasn't just one position driving the performance outcomes. It was actually quite diversified. So maybe if I just go through a few sort of key positions that we held in the portfolios through the course of 2024. Firstly, we did have a pro-growth stance in the portfolio for the first half of the year. And when I say pro-growth, that just means, generally, if you think about growth assets, there's typically equities compared to income assets. We generally had a little bit of an overweight to growth assets or equity assets through the first half of the year. And you think about, cast your mind back to sort of Feb, March, when the AI theme started to rise, the Magnificent Seven, et cetera. The portfolio has really benefited from being a little bit overweight, a bit more growthier than both the reference benchmark and the peer group. And then within the growth assets, so within equities, I guess our role is really to pick where we see the opportunities that will drive returns going forward. And for 2024, it was really around global equities. And so in terms of positioning within growth assets, it was an overweight to global equities and a little less allocated to Australasian equities, and also an allocation to emerging market equities as well. So the portfolios did very, very well through the course of 2024, through that rise of the Magnificent Seven, really underpinned by the emergence of that AI theme. Broad earnings for US equities were very, very strong in 2024. And you might have heard this narrative around US exceptionalism.
Mm-hmm.
So, the US equity market being, the biggest component of global equities, sort of around 70%. So all up, over the course of the year, global equities are up about 27%. Emerging market equities are up about 21%, and Australasian equities lagged behind, positive, but up about 12%. That was the right positioning to have within global equities in 2024. And then if I sort of shift to, I guess, the more defensive side of the portfolio and some of the key positions there, the standout really was gold. I think in previous podcasts, we talk about gold being a good diversifier. In 2024, it was actually one of the strongest performing assets globally. So in sort of unhedged New Zealand dollar terms, it was up about 42% through the end of 2024. We only have a small allocation in the portfolio. It's about 2%, but it absolutely punched above its weight in terms of contribution to overall returns. And then finally, I would call out the unhedged currency exposure. So when we invest offshore, when we invest in global equities, you have a choice of whether you want to hedge the currency exposure back to New Zealand or leave it unhedged. We prefer to have a fair amount of unhedged currency exposure, and that is really just the dynamic around the New Zealand dollar being a commodity-related growth currency, which typically it can underperform during these risk-off periods, and it acts as a quite a nice diversifier. And it just so happens in 2024, the New Zealand dollar depreciated by about 11%, which means your offshore currencies appreciated. So that was adding value to the portfolio. So there's a bunch of other sort of smaller drivers, but I think they were the sort of key things that drove the really strong performance in 2024.
So, John, any thoughts in terms of, I guess, building on what Griffo said, your thoughts on that year in review?
Yeah, look, I suppose if I just summarise the way I think about what David's just spoken about, it's very easy to look at the last 12 months and think that actually for our portfolios, gold and unhedged currency, the major things we got right. But I think in any given year, BlackRock has this approach, which is to diversify our exposures. And in any given year, some of those exposures will come off better than others. And I suppose this year it was the turn of gold and unhedged currency. But I think the key thing to see out of this is that there is a well-considered process, consistently executed, which is clearly about diversifying the portfolio across a number of different factors. And it paid off in this particular way this year. I think the position of the portfolio from the beginning of the year was just really, really well thought out. I'm looking forward to seeing what's going to happen for next year.
I love that line on diversification, which it always means having to apologise about something and never having to apologise about something. In terms of segueing into the next section, regular listeners of the show will know we've talked about the strategic asset allocation process before, or SAA. I guess it's important to touch on this a little bit further before getting into the outlook for 25 and to help people understand how this process fits into thinking about the future. John, what is the SAA process and why do we do it?
So the SAA process is SAA short for strategic asset allocation. So it's an asset allocation process. It's performed on a regular basis, and the BlackRock process that we've agreed with them. It's an annual process. Mm-hmm. It occurs about this time of the year, where BlackRock, David and the team look at the expectations for the year coming ahead and decide on how we should allocate the assets across global equities, to the points that David made before, global equities, bonds, whether we should be shorter duration, longer duration, inflation protection in the portfolio, those sorts of things that are going into that thinking, and then how do we allocate the funds across the asset classes. So it's an annual process. You don't expect it necessarily to change a lot each year because it uses a 3 to 5 year time horizon in terms of looking forward, but it's done on an annual basis, just basically to tweak the portfolio.
And so to ask a very simple question, we've talked about how the portfolios are positioned and how they performed, but I guess put simply, that doesn't mean we'll be positioned exactly the same way next year, does it?
No, it doesn't. I mean, over the past year, you've seen the markets do a variety of different things. You've seen gold go up a lot. You've seen the New Zealand dollar weaken. You've seen performance from bonds, from equities. You've seen US outperform. All of those things mean that if you look at it now versus last year, things will look a little different. And so the portfolio we'd expect will look a little different. Will it look materially different? We'll see. In
terms of the outlook, I guess, and how the portfolios will look, it's responding even though it might not look too much more, it's still got to operate in kind of a very fluid and changing environment. To start 25, we've seemingly got a new world order as such, with a new US administration. Geopolitics is still continuing to challenge things, and companies are kind of reporting mixed results here and there. Griffo, what's the outlook in terms of how you see it, or BlackRock for that matter, for 2025? And how do you see things panning out in markets or in the portfolio? Basically, tell us what you see in the future.
So that is a very difficult question in terms of what we see in the future, particularly now. And I think you phrased it correctly in that there's a new world order. And I think that's both from a geopolitics perspective, but also from an economics perspective. So I think what we've seen in markets so far year to date, they've been grappling with daily, almost hourly headlines from Trump around trade policy, tariffs, potential peace negotiations in Russia, Ukraine, downsizing the public sector in the US economy, the so-called Department of Government Efficiency, DOGE. And this is causing a lot of uncertainty, and hence, markets have been a bit volatile. And I think, markets have really been trying to digest or come to grips with President Trump's policy stance and the extent to which words are translating into actual policy. Trump has been talking tough about tariffs for a long time now, and markets have kind of been waiting to see if the rubber was actually going to hit the road. And I think we can see that now. Trump and the new administration mean what they say. They've got a clear mandate to implement their election promises, and they're intent on shaking things up, even if this means, short-term pain for long-term gain. And I think the clearest indication of this came from an interview around a week ago now with Treasury Secretary Scott Bessent. He described the current economic situation as a period of detox. The US economy has relied too much on public spending over the years, and they're looking to shift a bit of that into the private sector. And even President Trump himself also noted that there needs to be a transition period for the economy, and that we need to focus on the long term. He doesn't seem to be overly worried about the recent declines in the stock market, and also referenced China having a 100-year perspective. So, clearly there is this concept of trying to clean things up in the short term to get longer term benefits. And then beyond the US, we're seeing some quite, material shifts, particularly in Europe and in Germany, with Germany announcing a very large defense spend. It's something like just shy of 1 trillion euros to reduce the reliance on US defense. And this should be a boost for the European economy. There's this, obviously the ongoing tariff war, which is still very much in flux. So, there's a lot going on in markets, and I guess you really need to take a big picture view and look beyond just the daily headlines.
And here's the $1 million question. So what does all of the aforementioned things mean for portfolios?
Yeah, so I would say for us at BlackRock, we're focused on monitoring the underlying macro data, particularly when you've got all this noise in the headlines. It's very easy in these sort of environments to be whipsawed. You try to make a decision in a portfolio one day based on some policy announcement, and then that policy announcement is reversed the following day. You don't want to be whipsawed in making those types of decisions. So again, for us, what can you hang your hat on? You can hang your hat on hard underlying macro data, and looking at sort of some of the faster moving economic indicators or leading indicators. And there's nothing really that we're seeing in that data right now that points to, US or global recession. I would say that, we are seeing some softer data. Some of the manufacturing data is a little bit softer. We are starting to see higher inflation expectations in some of the surveys in the US. In terms of jobs data in the US, it still remains pretty resilient. And some of the data we're seeing in Europe is starting to pick up a bit. So overall, nothing is pointing to a dire sort of macroeconomic background just yet. But again, what I guess all the policy changes, are causing is a lot of uncertainty. And in that sort of environment, companies find it hard to make decisions, make it hard to make hiring decisions, investment decisions. So I think it is prudent to, just take a really focus on the shorter term data, just to ensure that the underlying macro environment is remaining strong and reacting to that if it's looking not that way.
And John, any pearls of wisdom before we get to the final question in terms of the year ahead or what you're looking at?
Yeah, just the standard sort of like response that I have to this sort of stuff. Having been around for a while, like it's different this time is something that I've heard like 7 or 8 times over the course of my career, and it's just never different. It's slightly different every time, but often it's framed in a way which is it's different this time, and the world's going to end, and the world won't end. Markets will correct, then they'll adjust, and they'll go forward again.
And I guess a final question is, we're mid-March when we're talking here, and we are currently going through just a period of elevated market volatility. And we get investor questions coming in and just asking us, sort of what we think. I mean, I've been saying a fair bit lately, and John will laugh because I've been saying probably every day, every correction feels normal except for the one you're currently in. And that's they happen more often than you'd think. John and then David, does this still apply in the current environment?
Well, they do feel different. When you're in the middle of them, they're really, really hard to handle. And I can go back. Unfortunately, I can remember the first correction that I ever experienced was back in 1987, which was called the 1987 crash, and the markets came down 20% in one day. But that year, they still ended up. And so I think
ended up higher than when they
started. They're up for the year. Absolutely right. And that sort of like repeats itself regularly through the last 30, 40 years that I can recall. So I think that people have just got to look through the sort of like the current volatility and realise that if you're exposed to equities, then there's going to be volatility, but equities historically have always gone upwards. They don't go up as much each year as they have for perhaps the last 2 years, but they will go up. So I just look through the volatility and look forward.
David, what still holds true for you and your team?
Yeah, for sure. Look, I think, John touched on it well there in terms of, KiwiSaver investors, have a long-term investment horizon. And it comes back to what I said earlier around looking through the noise. If you've got a long-term investment horizon, these little, corrections that we see in markets from time to time will really just be a blip on that longer-term horizon. And I would also add the way we've set up the ASB portfolios is we've embedded quite a lot of diversification in the portfolio in the last couple of years. Particularly through the second half of last year, diversifying a little bit out of global equities and into emerging market equities and listed infrastructure. And these two asset classes are performing, actually one of the two asset classes that are positive this year, where you've got global equities negative. We've talked a lot about gold, and that remains a feature in the portfolio. And you think about the big picture around, tariffs and what is the end game with tariffs. Essentially, it's inflationary. You might recall we added inflation-linked bonds to the portfolio a couple of years ago now. We've got an underweight position in duration. So look, I'm feeling reasonably comfortable around the level of diversification we've got in the portfolio, so to sort of weather the storm, I guess, a little bit over the short term. And I think you touched on it earlier. We are going through our annual review of the portfolios right now, not to spoil the surprise for John. But yeah, look, a lot of these sort of key decisions, it's going to be a tough one because there's a lot going on in markets. But I guess, the way we think about it is follow the process. We need to be disciplined and thoughtful around the recent headlines. But also, we have a process to follow that has worked historically, and we have a lot of confidence in that.
And two things I'd probably just leave listeners with that I always think of during periods like this. It's, and as the guys have said, the majority of portfolios, not just ASB ones, are heavily diversified. So don't conflate what is coming out of the US and the charts you might be seeing or what the media are talking about as representative of what's going around in all other asset classes. Griffith has just talked about a couple of there that are doing very well. So that's why you diversify. So it's a portfolio is not just what is happening in the US as such. And the other thing I always think of is do more of your hobbies. I always find I garden more when the market's having a bit of a temper tantrum because a watched pot seldom boils as fast as you need. So I'd say if you get a good hobby or invest in that and let the portfolios do what they need to do. So we're to our final question, my favourite question. Listeners will know what it is, but I'm going to ask the guys, what are you currently reading, watching, listening to, or having done that you want to share with listeners? David, you've got something to update us on that listeners will know from our last podcast, a certain trip that you went on?
Yes, that's right. Yeah, I've just come back from Cambodia, actually. It was a social impact trip. So BlackRock every year sponsors a trip somewhere in the Asia-Pac region. In previous years, it was Nepal. This year, it was with Cambodia. And we partnered up with a charity called A Drop of Life, who provide clean water and sanitation to local communities. So it was a really rewarding experience. You know, we partnered up with a local charity there that runs a school. There was 600 students. The importance of cleaning hands in the classroom. We sang songs. We did a little dance with them, and then we went out and we actually did a few projects of installing a water bore to provide clean water, and built a toilet block actually as well. So yeah, so a bunch of BlackRock people rolling up their sleeves, getting their hands dirty, doing 3 days of pretty hard work. I think it was about 36 degrees and a lot of humidity. So, but yeah, look, it was a lot of fun and very rewarding.
Oh, congratulations. That sounds like a trip of a lifetime. That aside, I'm keen to, when we next catch up, I'm keen to hear how your dancing and singing was, Griffith. That'd be something I'd like to debrief on.
It's never good.
Well, I'd rather that was suboptimal versus your portfolio management work for us. John, what can you recommend? Is there anything you'd like to pass on to listeners?
Nothing as exciting as what David's done. I just want to check out his hands and see what blisters he's got. So, but for me, I browse a lot of podcasts at different times, and my recent browsing has been mostly about history videos. Actually, I've been interested in the geopolitics that's going on at the moment, and just trying to understand Russia and Ukraine and the history of those two countries and what's behind the conflict in a historic sense. I think that was where I started, and I've just been just browsing. So it leads you into other areas, and I think this morning I was looking at Spain and Portugal.
I saw on your phone.
Yeah,
I saw it
anyway.
Before you started work. Work.
Absolutely.
Well, my recommendation is a classic book title or series from way back when. My daughter has gotten into the Goosebumps series again. So little, like kid horror movies, sort of, in the shape of a book. She's rediscovered them, and I just thought it's just like Europe coming back into vogue as an investment destination. It's fun watching things you forgot about get rediscovered by others. So I'm enjoying reading that with her. Gentlemen, thank you again for your time and expertise. As always, it's a pleasure having you both on the show again, so thank you. And I wanted to also take a moment to thank, I haven't done this before, but all the team behind the scenes here too. They're the ones who make everything run, sound, and look so good. Cole, Tom, Sarah, Brian, Nikki, Tom, the other Tom, Nicola, Jasmine, and Natalie. Thanks so much for all your hard work behind the scenes. We really appreciate it. And to our listeners, thanks again for tuning in to the show. As you can hear, and you probably would have seen, there's a lot going on in world markets at the moment. But we hope today's show has given you an insight into how we're thinking about all this, not just what's going on, but also how your portfolios are positioned, and most importantly, the knowledge that they will continue to be set up for the long term. So with that, it's happy investing, and bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.